Then in part B, calculate the actual return on investment for Division B for the 2019 financial year and discuss which division has, in your view, achieved better performance. Then there's 1 mark available for communication skills, and that is awarded for logical argument. All right, guys, so please be careful. There's 2 parts to the required. First, you're going to calculate the actual return on investment for Division B for the 2019 financial year. And then after that, you're going to discuss which division has, in your view, achieved better performance. All right, and you don't need to calculate the actual return on investment for Division A, because if you go back to the information provided in the scenario, you were told that the manager of Division A has determined that the actual return on investment for the 2019 financial year is 35%. All right, so you've been given their actual return on investment. We just need to calculate the actual return on investment for Division B. And here's all of the actual results for Division B. So, how do we calculate return on investment firstly? Now guys, I'm just going to jump to the suggested solution because this is a very simple calculation. You need to know your formulas. There's no excuse for not knowing the formulas. So I'm not going to waste time writing all of this out. You should not have struggled with this part of the required. It is very straightforward. How do we calculate return on investment? It is controllable profit before interest and tax divided by controllable investment. So first we need to calculate controllable profit before interest and tax. Now, if you go back to the information provided, you've been given the net income before interest and tax. It's 11.7 million. However, we do know, based on the information provided in Note 3, organizational overheads relating to head office costs are allocated to the divisions. Now, obviously, any allocated cost will not be under the control of the divisional manager. So this cost needs to be eliminated. And once this cost is eliminated, we'll then have controllable profit before interest and tax. And we said it's a very simple calculation to calculate these organizational overheads. It's the fixed cost of 13.8 million rand multiplied by 30%. All right, so start with the net income before interest and tax. Add back the allocated head office costs, which is 30% of the total fixed overhead. And that will give you the controllable profit before interest and tax. Then we need to calculate the controllable investment. And remember, the controllable investment is non-current assets plus net working capital. And net working capital is just your current assets minus your current liabilities. So once again, all of this information was provided. There's your non-current assets. Net working capital is your current assets minus your current liabilities. Taking all of that information into account, you can calculate the controllable investment. Please remember, guys, if the question is silent, it's safe to assume that the non-current liabilities are not under the control of the divisional manager, and they should not be taken into account in the calculation of controllable investment. But in this question, you were also specifically told that head office is responsible for all long-term financing agreements. So you shouldn't take the non-current liabilities into account in your calculation. All right, so again, very simple calculation, guys. That's the non-current assets. Your net working capital is current assets minus current liabilities, and that gives you the controllable investment. All right, so that's the first part of the required. We've calculated the actual return on investment for Division B, and it's 26%. Now we need to discuss which division has, in your view, achieved better performance. So what was the actual return on investment for Division A? It's 35%. So Division A has a higher return on investment than Division B. Now this part of the required is out of 10 marks. And by performing the simple return on investment calculation for Division B and discussing the fact that Division A has a higher return on investment and therefore they've performed better than Division B, that's obviously not going to score you 10 marks. There's something else missing here. So what do you need to discuss further? You need to consider the disadvantages or the limitations of using return on investment as a performance measure. Because guys, when we read through the information provided in the scenario, you would have seen that Division A and Division B have very different asset bases. Firstly, we know that the that Division A was established in 2009, whereas Division B was established in 2015, 6 years later. Now that means the assets sitting in Division A are going to be further depreciated because they are older, whereas the assets sitting in Division B won't be as depreciated. They've only had 4 years of depreciation, so the carrying values will be a lot higher. So because of the fact that Division A is older and Division B is newer, Division B's assets should have a higher carrying value and Division A's assets should have a lower carrying value. But that's not the only difference between the two divisions. We also know that Division A rents the premises that they operate from, whereas Division B owns the premises that they operate from. So once again, this tells us that Division B has a higher asset base and Division A has a lower asset base. But there's another difference that also affects their asset bases. Division A is labor intensive, whereas Division B is highly automated. Now, if Division B is highly automated, that means they use a lot of machinery in their production processes. Once again, telling us that they own more machines, so the assets in Division B are higher and the assets in Division A are lower. Now, think about how this is going to affect the return on investment calculation. If your assets are a lot lower, then the return on investment is going to be a lot higher. On the other hand, if the assets are higher, you are dividing by a higher amount, then the return on investment is going to be a lot lower. So that's the reason why Division B has a lower return on investment than Division A. It doesn't necessarily mean that Division B has performed worse than Division A. It's because Division B has a lot more assets than Division A. So obviously, if their controllable investment is higher because they have a lot more assets, because this amount over there is higher, that is reducing their return on investment. So using return on investment as a performance measure, it's not possible to accurately conclude which division performed better during the 2019 financial year. All right, so let's quickly go through the suggested solution to make sure that you're happy with everything over here. From our calculations, we saw that Division A has a higher return on investment than Division B, 35% compared to 26%. However, this does not necessarily mean that Division A performed better than Division B. One of the limitations of return on investment is that comparisons between divisions with different asset bases is difficult. And we know, based on the information provided in the scenario, that Division A and Division B have very different asset bases. Firstly, Division A rents premises, whereas Division B owns the premises that they operate from. So obviously, if Division B owns the premises that they operate from, they are going to have much higher assets than Division A. Also, Division A is labor intensive, whereas Division B is highly automated or capital intensive, meaning that they own a lot more machines. So once again, they have a higher asset base. We also know that Division A was established 6 years before Division B, and therefore Division B's assets are newer with higher book values. So because Division B has a much higher asset base, that is reducing their return on investment. So using return on investment as a performance measure, it is not possible to accurately conclude which division performed better during the 2019 financial year. All right, so that deals with part B. You shouldn't have struggled with that. That was very straightforward. Then in part C of the required, you need to calculate the minimum and maximum transfer price per unit, assuming that Division B purchases the motherboards internally from Division A. All right, and this is only for 3 marks. So if you go back to the information provided in the scenario, normally how do we calculate the minimum transfer price? We take the variable costs associated to producing the motherboard. We deduct any variable costs saved on internal transfers, we add any incremental fixed costs, and then we add any opportunity cost. Now guys, you can see there's insufficient information provided in the question to perform the calculation in that way. we don't know what the variable costs are to produce a single motherboard. We only know what the labor cost is, and we also know that if the motherboards are sold internally, packaging costs of 50 Rand per unit will be saved. That's the only information that we know, and we also obviously have the external selling price per unit. We don't have the variable cost of producing a single motherboard, so you can't perform the calculation in that way. However, if you go back to your lecture notes, you'll remember I said to you in the lecture where we covered transfer pricing, if the division is operating at full capacity, and Division A is operating at full capacity, they operated at maximum capacity during the 2019 financial year. So because we know that they are operating at maximum capacity, we can calculate the transfer price by using the external selling price and deducting any costs or any variable costs, that will be saved on internal transfers. So in other words, this packaging cost that will be saved on internal transfer should be deducted. And by performing the calculation in that way, Division A will be in exactly the same position as they would have been if the products were sold externally. Let's have a look at the calculation, and then I'll discuss this again with you to make sure that you're happy with the logic. So in order to calculate the minimum transfer price, you take the external selling price of 1,250 Rand per unit, and you deduct any variable costs that are saved on internal transfers. So that's the packaging cost which is saved on internal transfers. And that will give you the minimum transfer price. And please note, the only reason why you can perform the calculation in this way is because Division A is operating at maximum capacity. In other words, they don't have any spare capacity. So that's why we can perform the calculation in this way. And by performing the calculation in this way, we've made sure that Division A will be in the same position as they would have been if the products were sold externally. Now think about this logically. If they sell the motherboards on the external market, they sell them for 1,250 Rand. But they have to incur packaging costs when they sell externally. So if they sell internally and they don't have to incur packaging costs, they will be in exactly the same position as selling externally if they sell internally for 1,200 Rand per unit. That way their profit will be exactly the same. And Division A won't care if they are selling internally or externally because their profit will be exactly the same. So that's the logic behind that calculation. And please note, guys, if there was sufficient information available, if you could take the variable cost per unit, deduct variable costs saved on internal transfers, add incremental fixed costs, and add an opportunity cost, you will come to exactly the same answer. But you can't perform the calculation like that in this question because there's not enough information available. All right, so please take notes of this. And you'll see this is covered in our lecture. I show you how to first calculate the minimum transfer price by taking the variable costs, minusing the variable cost saved, adding incremental fixed costs, adding the opportunity cost. And there's one example where I show you the company or the division is operating at maximum capacity, and as an alternative, you can also perform the calculation in this way. So please don't say there's missing information in the question. I did that deliberately to try and trick you guys to make sure that you know everything that you're supposed to know and you're not just learning things off by heart. Then, how do we calculate the maximum transfer price? Remember, there are different calculations depending on the information or depending on whether the product can be purchased on the external market or not. Here there is an external market. We know that Division B is currently purchasing the motherboards on the external market. So if there is an external market, you take that external market price, which is 1,250 Rand per unit, and then once again you need to deduct any variable costs that would be saved if Division B purchased the motherboards from Division A. So they would save delivery costs of 10 Rand per unit, and they would also save ordering costs of 5 Rand per unit. So take that into account, and that will then give you the maximum transfer price. So you take the external market price. So what is B currently paying on the external market? They are currently paying 1,250 Rand. If they buy internally, they won't incur the delivery costs and the ordering costs. So they'll save 15 Rand per unit if the motherboards are purchased internally. So that gives you a maximum transfer price of 1,235 Rand per unit. All right, So the transfer price will fall somewhere between the minimum and the maximum. So it will fall between 1,200 and 1,235 Rand per unit. And the final transfer price will be obtained through a process of negotiation between the two divisional managers. All right, and that then answers part C of the required.